Hey guys, and welcome back to my channel. A Vancouver developer is facing 3 major insolvencies that just came to light through the public channel in the last week. We're going to talk about that situation, specifically what it means for consumers, buyers, and sellers. I'm also going to give you some insight from a discussion I had with a developer earlier this week. And then I'm going to do a quick market update that's going to be pretty interesting in terms of what's happening from a feet on the street perspective. Real quick, if this is your first time to the channel, my name is Hassan. I'm a real estate agent in the Vancouver area, and I make educational real estate content to help you on your real estate journey. When I'm not making videos like this, I'm helping people just like you buy and sell real estate across the Lower Mainland. So if that sounds interesting to you, or you just wanted to chat with me about your real estate situation one-on-one, you can book me for a free call in the Calendly link below and on screen, and subscribe to this channel so you don't miss a future video. All right, we're gonna hop right into it. I hope you had a wonderful week. The biggest news of the week is of insolvencies in the development space. Vancouver developer, Thin Properties across 3 separate properties now placed under receivership. One in Surrey, basically a Surrey high-rise site. You have a site in Richmond, Minaru Square, which we knew they had canceled the project some time ago, over a year ago. So it doesn't look like that's going to come to fruition at all. And then also a third site where there's actually a finished product. So the developer held a lot of inventory there, newly constructed inventory, and it sounds as if there was a loan placed against that inventory. So, 1,800 total homes across these 3 projects. If I were to say, something that's unique to this scenario, because if you followed my channel, this is not unique or specific to this one developer. This is a pain that is being felt across the development community and has been over the last 2 years, under the radar, away from the news sources and stuff like that. There has been a lot of situations similar to this where big name developers have been stretched and struggling to make payments on loans. Very often what they have found themselves doing is being able to deleverage, being able to perhaps sell off assets, being able to jointly come together and construct joint ventures that would deleverage themselves. So people don't generally hear about it, the general public, but behind the scenes, this is not new, and I want to just specify that this is not new and this is not specific to this developer. A couple of unique things before we touch on what does this mean to the consumer? So for example, the Surrey site, District Northwest, 90% sold. So that is something that I would say is unique. 90% sold. You've essentially hit a threshold where the lender will provide you the funds to construct the project. But in this case, the lender, it happens to be the same lender across all 3 projects, one of the largest private lenders across the country, I guess earlier this year, said we're not going to advance you the funds. So wanting to limit their exposure with the one developer, and 90% sold. So that's a little bit different. Most often that lender is ready and willing to loan the funds, and this project would have went off the ground. For that specific project, there's obviously a lot of buyers out there that bought in pre-sale. What's going to happen? It sounds as if the developer is working on either some sort of joint venture agreement or having another developer entirely take over the project. So that's likely to move forward. It will move forward. Maybe timelines get touched a little bit. So from the consumer side of the equation, not too much to change, and there are some protections in place for you. A big question might be, what happens to my deposit? Now, a couple of things, and again, we've talked about this on my channel before. A couple of things is your deposit is placed in trust. So meaning that the developer is not out there spending your deposit. It needs to be held in trust. And if they do spend the deposit, they have to have insurance on your deposit. So it's readily payable back in a circumstance like this, as an example. Now, the second side of the equation is developers have a certain amount of time to be able to complete the project, which we call an outside date. So until that outside date has arrived, they can hold your deposit as they continue to try and get financing. They continue to try and break ground. In this instance, very different. Again, another developer likely to step in. In terms of the total amount of debt, it's a staggering number, over 300 million across these 3 projects. And I mentioned how not unique to a specific developer here. Over the last 6-7 years, we've seen several developers acquire lands. A lot of these lands don't have any sort of income on them, whether that be a multifamily building that exists already where they're at least generating some sort of income, very often vacant lands. So, you purchase these lands, inflated prices, the market is hot, and all of a sudden your borrowing costs start going through the roof. Essentially, you have no money coming in, your construction costs keep going up. As it stands today, of this debt amount, the interest now is about $100,000 per day, just under $100,000 per day. So, District Northwest Surrey very likely to proceed forward. Minaroo Square was a dead project, as was. And then the Burnaby project, Highland, I believe it was called, where there's actually existing units, newly constructed, and a loan against that. I think that's going to be pretty interesting to see what happens in that regard, how those units are sold. Is it going to be a bulk sale scenario? Who's going to be the buyer for that type of a scenario? So going to be very interesting to watch. A lot of us in the industry had headwinds that something along these lines might have been coming. Again, not specific to a developer, but knowing the challenges the developers face, this is not surprising at all. All right, so continuing along on the Vancouver construction front, I want to talk about a chat I had with a developer yesterday. I wanted to get a bit of a line of sight in terms of how are they looking towards the future from an optimistic, pessimistic point of view? What are the pain points today? Are they different than in years past? What are the margins today? Are they different than in years past? His insight for me was, the struggles continue to be the construction costs, the delays at the city, the costs to upgrade services depending on what type of project you're doing, whether that's a duplex, whether you're stepping into the world of the multiplex, which is a newer sort of development style, that row home project, and then high density kind of in its own sort of scenario. You're seeing as well a lot of, like I mentioned earlier, a lot of these joint venture style partnerships where developers are coming together. They're deleveraging a little bit in that process. Now, going down the joint venture route, that brings a whole host of other problems. You can have the tightest joint venture agreement, but if one side of that joint venture partnership doesn't pull their weight, doesn't do what they need to do, it still takes time to be able to get out of that joint venture, and time obviously adds to costs. Ultimately add to the end user costs, delays on housing, delays on supplies. So these joint venture scenarios, I think they're adding a little bit of a complexity in the market. I had another developer call me out who's looking for joint venture partners for the Lower Mainland as well to try and deleverage. So I think we're going to start seeing, again, a lot more of these sort of joint venture partnerships. Brings a whole host of other challenges. Now, from a margin perspective, like what are developers looking at today versus maybe what they were making in the past? The target has generally been, and every developer's pro forma is different, but say 15 to 20%. But that margin it gets eaten away by the contingencies that you place into the project, whether that's enhanced construction costs like we talked about, labor. So what I'm noticing out there is, and this was affirmed in my conversation, is that this developer here has the means to do something of greater scope, could definitely be doing high density, in fact has high density land that they could be working on, but instead what they're doing is they're scaling back and they're mitigating risk and they're focusing on smaller style development, whether that's duplex or multiplex. And I think this is something that is going to be also a bit of a trend as we head into the next year and even the year beyond that. I think we're going to start seeing developers just taking on less risk entirely. Generally, when the market is excited, when developers are excited, when buyers are excited, people are generally taking on more risks in their lives in general. And this doesn't change when we're looking at it from a development angle. But I think we're going to see developers that have the means to do something of greater scope actually scale back and stick with what is tried and true, perhaps building less units. We talk a lot on my channel about supply and demand. Looking forward into next year, when we talk specifically about pre-sales, I don't see how pre-sale developers can be extremely excited about the prospect of what next year looks like from a demand perspective. We have mass immigration changes that are basically going to halt our population growth. This generally, when our population is growing, look, it brings on a whole host of problems. I'm not saying that it doesn't, but what that does is it encourages investment into the market, investment into real estate. When we talk about a pre-sale project, we talk about, I'm going to throw out numbers just as an example. Say we have a 350 unit tower. We have, 7% of those are studios. We have a vast chunk of those that are 1 bedrooms. Then we have a large chunk that are 2 bedrooms and a small, again, percentage that are the 3 bedrooms. Now, in order to get that pre-sale funding, in order to get that project moving and off the ground, that developer needs to sell 60 to 70% of those units in pre-sale. And the buyer in pre-sale early on, buying some of these smaller units, buying them so that they can purchase them, rent them out in the future, that is the investor buyer. So, if that investor nowadays is not as excited to be investing in real estate, pre-sale real estate, Canadian Canadian anything, how is that developer going to hit their minimum, on that supply? How are they going to actually get their financing? When you start pulling the investor out of it, and when you start creating policies provincially and nationally that affect the investor's appetite to invest, you're going to see that struggle. Markets have a very interesting way of working themselves out. Again, supply and demand. If the demand's not there, the developers are not going to build. The supply will drop over the long term. Prices will go back up. The market generally works itself out. But I just don't see, even with rates coming down, I don't see this scope of excitement towards investing for developers to be investing and building out pre-sales. I just don't see it happening. Those margins that I talked about, the 15 to 20%, now they've shrunk to say 12 to 16%. Again, contingencies tend to eat that up. And depending who you talk to, people out there will say, well, pre-sales are so expensive, $1,200 a square foot, $1,300 a square foot, whatever it might be. And the price tag is high, but let's not confuse ourselves thinking that developers today are charging more because they're making more money. Developers today are charging more at the hope of making the same amount of money they've made in years past, with the understanding that they're very likely to make less. All right, so before I close off this video, I want to give a feet on the street perspective of what's happening in the market right now. Market is definitely more active, more sales transactions happening. We had a huge lift in sales activity from September to October. This should not be confused with prices rising. I've had this conversation several times with sellers over the last 2 weeks. Even though the market is more active, you're hearing the headlines right now. Ultimately, what has happened is sellers have been coming back down to earth. The prices have been dropping, and they've dropped enough now that buyers are back and entering the market. And I think the reason this is happening is sellers now have incentive to actually sell the home. In the last year and a half, with the rates being so high, a lot of sellers, they didn't really know what their next step was going to be. They were putting a flag out in the yard, really high price, did videos on this several times, dead inventory, and ultimately they just didn't really know where they were going to go next, so they didn't want to concede anything on price. And that's changing now. Now that the rates are a little bit more palatable, and there's more of an outlook in terms of this is the move I want to make in Q1 of next year, sellers are now bringing their prices down to earth. Buyers are starting to eat it up. So we've now seen attached homes, condos enter into sellers' markets. Not enough to move pricing upwards just yet, but I do think that at the floor of real estate prices, I do think it's going to go up. I'll give Surrey Central as an example. Surrey Central condos, tons of inventory. It's a big story. That inventory has been pretty consistent now since July, August. It hasn't climbed much. Sales pretty much exploded last month. Pricing has remained flat. So what we're starting to see now is that the inventory is starting to get eaten up of these Surrey condos. And it's only a matter of time before enough inventory gets eaten up, the months of inventory shrinks down, and now that prices starts inching upwards. So if you're a buyer right now, don't Don't get scared when you hear, oh, the market's active again. There's still lots of opportunity out there. There's still lots of inventory that, again, is now coming back to earth price-wise where you can get a good deal. Now, this is why I'm pretty gung-ho and bullish on resale condos right now, coupled with what I was just mentioning, how developers are charging, higher for pre-sales, not because they're trying to make these crazy profits. They're trying to actually make some sort of profit. And so if the gap is very wide between what you're paying for pre-sale versus resale, for me, there's a lot of value in that resale condo market depending on where you're looking. So buyers, opportunity exists. I think it's going to be a busy spring market. I think spring market's going to come early. I think it's going to be more of a February thing versus a March thing. And it's going to continue along as we see further rate cuts. So there you have it, guys. I hope you enjoyed this week's video. If you did, hit the like button and consider subscribing to this channel. What that does is it takes the video and it sends it out to more people so they can also learn from it. And again, if you're in the Lower Mainland, you want to chat with me about your real estate situation, you can book me for a free call, or you can just give me a call, send a text, shoot me an email, whatever is easiest for you. All my contact info is in the description box below. But I want to thank you again for watching this week's video, and I look forward to seeing you next week.